Hello and welcome. Today, we're going to unpack one of the most intriguing mysteries in global economics. Have you ever looked at the US national debt, seen that number with all those zeros, and just wondered, who on earth do we owe all this money to? Is it China, Japan, some secret group of global financiers? Well, a big chunk of it is owed to someone you might not expect, ourselves. Today, we're diving deep into one of the most fascinating and misunderstood aspects of modern economics, the bond trick, or how the United States government essentially buys its own debt. It sounds like a magic trick, and in a way, it kind of is. So grab a coffee, settle in, and let's unravel this economic mystery together. First, let's get the basics straight. When the US government needs to spend more money than it collects in taxes, which is most of the time, it has to borrow. It does this by issuing something called a Treasury bond. You can think of a bond as an IOU. You buy a bond from the government, and you're essentially lending it money. In return, the government promises to pay you back the full amount after a certain period, plus regular interest payments along the way. It's generally considered one of the safest investments in the world because it's backed by the full faith and credit of the US government. So, who buys these bonds? Lots of people and entities. Foreign governments like Japan and China are major holders. So are private investors, pension funds, insurance companies, and even individuals like you and me through savings bonds or mutual funds. They all buy these bonds because they're a stable, reliable way to earn a return on their money. This is the normal, everyday market for government debt. But here's where it gets interesting. A huge portion of these bonds are bought by the US government itself. Wait, what? How can you owe money to yourself? It sounds like taking money out of your right pocket and putting it in your left pocket, then writing an IOU to your right pocket. To understand this, we need to introduce the two key players in this process, the US Treasury and the Federal Reserve, also known as the Fed. The Treasury is the part of the government that manages the country's finances, collects taxes, and, importantly, issues the bonds to borrow money. The Fed is the central bank of the United States. Its job is to manage the country's money supply and keep the economy stable. While it's a part of the government structure, it operates with a degree of independence. Think of them as two separate entities with different jobs. The Treasury needs to borrow money to pay for things like infrastructure, defense, and social security. The Fed's job is to make sure the economy has the right amount of money flowing through it to keep prices stable and employment high. And their paths cross in a very significant way through something called open market operations. This is the primary tool the Fed uses to influence the economy, and it's the core of the bond trick. Here's how it works in a simplified way. Step 1. The Treasury announces it needs to borrow, say, $100 billion. It creates and auctions off new Treasury bonds to raise that cash. These bonds are initially bought on the primary market by big financial institutions, think major banks, called primary dealers. They are obligated to bid at these auctions. So far, so normal. The government has borrowed money from the private sector. But now, here comes the Fed. Step 2. The Fed steps into the secondary market, which is where bonds are bought and sold after their initial auction, kind of like a used car market but for financial assets. Using its authority, the Fed decides the economy needs a boost. Maybe unemployment is high, or a recession is looming. To stimulate the economy, the Fed wants to increase the money supply and lower interest rates to encourage borrowing and spending. So, it goes to those primary dealers and says, "Hey, we'd like to buy some of those Treasury bonds you just bought." And here's the magic part. How does the Fed pay for these bonds? It doesn't use tax money. It doesn't have a giant vault of cash saved up. The Federal Reserve, as the central bank, has a unique power. It can create money electronically out of thin air. It simply credits the bank accounts of the primary dealers with new, digital dollars in exchange for the bonds. That's it. New money has just been injected into the financial system. The bonds are now moved from the primary dealer's balance sheets onto the Fed's balance sheet. So, let's trace the journey. The Treasury issued debt. The private banks bought it. The Fed then bought that debt from the banks using newly created money. In effect, one arm of the government, the Treasury, has issued debt that is now owned by another arm of the government, the Fed. This process is known as monetizing the debt, or, more formally, quantitative easing, or QE. You've probably heard that term a lot, especially since the 2008 financial crisis and the 2020 pandemic. During those times, the Fed bought trillions of dollars worth of Treasury bonds to keep the economy from collapsing. Now, why do this? What's the point? By buying up all these bonds, the Fed accomplishes a few things. First, it increases the demand for bonds, which pushes up their price. When a bond's price goes up, its yield, or the effective interest rate, goes down. This is crucial. Lower interest rates on government bonds ripple throughout the entire economy. It makes it cheaper for businesses to borrow money to expand and hire new workers. It makes it cheaper for people to get mortgages to buy homes or take out car loans. The goal is to stimulate economic activity by making money cheaper and more accessible. Secondly, as we mentioned, it injects new money directly into the banking system. With all this extra cash on hand, banks are more willing and able to lend money out to the public, further fueling economic growth. So, in times of crisis, this bond trick is a powerful tool to prevent a complete economic freeze-up. It acts as a massive financial stimulus package, without needing to go through the lengthy political process of passing a spending bill. Of course, this sounds a little too good to be true, right? Creating money out of thin air to buy your own debt. What are the catches? Well, there are significant risks and debates surrounding this practice. The most obvious one is inflation. The fundamental law of supply and demand applies to money too. If you dramatically increase the supply of money in an economy without a corresponding increase in the amount of goods and services being produced, the value of each dollar goes down. That means prices go up. We all felt this recently, as the massive QE programs during the pandemic were a major contributing factor to the inflation surge that followed. Finding the right balance is incredibly tricky. If the Fed prints too much money, it can lead to runaway inflation, eroding people's savings and purchasing power. If it doesn't do enough during a crisis, it risks a deep and prolonged recession with mass unemployment. It's a constant tightrope walk. Another concern is what some call an asset bubble. When the Fed pushes interest rates to near zero, investors looking for a decent return are forced to put their money into riskier assets, like stocks or real estate. This can artificially inflate the prices of those assets, creating a bubble that could pop with damaging consequences when the Fed eventually raises rates again. And finally, there's the question of independence and long-term consequences. Does this process make it too easy for the government to spend without consequence? If the Treasury knows the Fed will always be there to buy up its debt, it might be tempted to borrow and spend irresponsibly, kicking the can of national debt down the road indefinitely. This relationship blurs the lines between fiscal policy, government spending, and taxing and monetary policy, the Fed's control of the money supply, which are supposed to be separate. So, to recap the bond trick, the Treasury issues debt to pay its bills. Big banks buy this debt. Then, the Fed creates new money to buy that debt from the banks, which pushes down interest rates and stimulates the economy. It's not a secret conspiracy. It's a complex and public monetary policy tool called quantitative easing. It's a powerful mechanism for managing economic crises, but it comes with the very real risks of inflation and asset bubbles. Understanding this process is key to understanding how our modern economy really works, especially in times of trouble. It's not magic, but it is a powerful form of financial engineering that shapes the world we live in. Thank you so much for sticking with me through that deep dive. I hope it cleared things up. If you found this video helpful, please hit that like button, and be sure to subscribe and turn on notifications so you don't miss our next exploration into the world of economics. Let me know your thoughts in the comments below. See you in the next video.